Every bear has been wrong about this stock for 3 years, and it is now the most owned company on earth. So here is the coldest read there is: the methods, the money, the crowd. Then you be the judge.
For 3 years, some of the smartest people on Wall Street have called this stock overvalued. They have been wrong every single time. Now, with a market cap approaching $5 trillion, the five greatest investor frameworks in history sit down to decide, does the company that built the engine of the AI revolution still make sense at this price? None of what follows is financial advice. These are AI models of documented investment frameworks, not the investors themselves. The board convened in June 2026. Nvidia's market capitalization at that moment, approximately $5 trillion, the most valuable company on Earth. Let's understand why and whether it should be. Most people know Nvidia makes graphics cards for gaming. That was true for 3 decades, then something changed. In 2012, researchers used Nvidia GPUs to train the first deep learning model that could recognize images as well as a human. Every major AI breakthrough since has run on Nvidia hardware. The company built the shovel during a gold rush and then discovered the shovel is also the gold. In the first quarter of fiscal 2027, Nvidia generated approximately $44 billion in revenue. That is nearly $44 billion in one quarter. Running at that pace, the annual revenue engine approaches $175 billion per year. 3 years ago, the whole company made about $4 billion a quarter. Revenue grew approximately 69% year over year. Revenue, not earnings, the top line nearly doubled in 1 year on a base that was already one of the largest in technology. This is why the bears have been wrong. Every quarter they expected a plateau, every quarter they got a new record. Nearly 90% of that revenue comes from data centers. Hyperscalers, Microsoft, Google, Amazon, Meta are spending hundreds of billions of dollars to build AI infrastructure, and almost all of it runs on Nvidia GPUs. The company went from a gaming chip maker to the mandatory toll booth of the artificial intelligence era. Here is the number that makes analysts pause. A hardware company, a company that manufactures silicon, is earning approximately 75% gross margin. That is not a hardware margin. That is a software margin, wearing hardware clothes. It is what pricing power looks like when you are the only supplier of something the entire world needs. The real moat is not the chip, it is the software. In 2006, Nvidia released CUDA, a programming platform that lets developers write software specifically for GPU acceleration. 18 years later, more than 1 million developers have built their careers on CUDA. Every AI model, every training framework, every research lab is written in CUDA. To switch away from Nvidia is to retrain an entire global workforce from scratch. AMD has tried, Intel has tried, Google and Amazon have built their own chips in-house. None of them have an ecosystem. The training frameworks run on CUDA. The research papers are written assuming CUDA. The engineers know CUDA. AMD and Intel are not trying to build a better chip, they are trying to build a better operating system when Microsoft already has 1 billion users. The moat is compounding. Jensen Huang founded Nvidia in 1993 and has never stopped running it. He owns approximately 3.5% of the company, personally worth roughly $175 billion at today's price. He made the pivotal bet in 2012, redirecting the company's entire GPU roadmap toward AI workloads when the market could not see why. He was right before the market understood the question. Which brings us to the price. In June 2026, Nvidia trades at approximately 31 times trailing earnings. That sounds expensive. But for this specific company at this specific historical moment, 31 times is unusual for a different reason. It is actually about 40% below Nvidia's own 10-year median PE of around 53 times. The stock is expensive versus the market. It is cheap versus itself. One ratio matters to the next legend on the board more than any other. The PEG ratio, price to earnings divided by growth rate. If earnings are growing faster than the PE multiple, Lynch calls that a bargain, regardless of how high the absolute number looks. For Nvidia, with earnings growing more than 80%, the PEG falls below 0.4. Lynch built his entire career on finding numbers like this. But there is a number on the other side of this ledger. China. A Senate Commerce Committee hearing on June 11, 2026 took bipartisan aim at the H20 chip, the China-compliant version Nvidia designed specifically to work around existing export controls. If that hearing produces law, Nvidia loses its last legal channel into the world's largest semiconductor market. That risk is real, ongoing, and unresolved. Nvidia's China revenue in fiscal 2024 was approximately $14 billion. roughly 10% of total. That is the direct exposure. The larger risk, if the US tightens controls further and China accelerates its own domestic chip industry, the long-term growth story in the world's fastest-growing AI market dims. Every bull thesis has to reckon with this. Here is what the board is looking at: approximately $44 billion in quarterly revenue, nearly 70% year-over-year growth, 75% gross margins, 18 years of CUDA ecosystem moat, 31 times trailing earnings, 40% below its own 10-year median, a peg below 0.4, and a Senate hearing that could cost it 10% of its total revenue overnight. 5 legends, 1 verdict. Philip Fisher, he invented growth investing. His 15-point framework asks not whether a company is cheap, but whether it is so fundamentally superior that time itself becomes an asset. He spent his career looking for companies he could hold for 20 years without needing to check the price.
Fisher's model asks one question above all others. Is this business capable of sustaining above-average growth long enough to compound into something extraordinary? Nvidia's CUDA ecosystem answers that question with one of the clearest yeses in the history of technology investing. A moat that has been compounding for 18 years, in an industry where the demand curve is now vertical, built by a founder who is still running the company. He cares deeply about management quality. Jensen Huang is one of the finest capital allocators in the modern era by every metric his framework uses. Consistent reinvestment in R&D, no dilutive acquisitions, a long-term product vision executed over 3 decades. Fisher spent his career looking for exactly this kind of operator. He would call Jensen Huang's handling of the CUDA pivot the single best strategic bet he has observed in 50 years of watching technology businesses. His framework does not penalize a high price in an exceptional business. He watched investors pass on Motorola at 12 times earnings and miss a generation-defining run. The question is not, is 31 times expensive? The question is, what will this business earn in 10 years if the AI infrastructure build-out is real? His answer: Nvidia has a rightful claim to being the defining infrastructure company of the AI era. He scores it an 8.
An 8 from Fisher, the growth legend is fully committed. Now the man whose entire philosophy was built on the opposite premise: never bet on a future you cannot put a floor under. Benjamin Graham, he taught Warren Buffett. He spent 50 years developing one idea: never pay so much for a business that being wrong about it can ruin you. Safety was not just a preference, it was the method.
Graham's model begins with the balance sheet, and Nvidia's balance sheet does not give him a place to stand. At $5 trillion of market capitalization, the gap between what Nvidia is worth on paper and what the market says it is worth is so large that no asset-based calculation comes close to justifying the price. He does not need to model the future to reach his conclusion. The present numbers are enough. He will acknowledge the earnings are real. Nvidia is not a speculation on a future product. It is generating tens of billions of dollars in profit per quarter. That earns partial credit in his framework, but consistent earnings at 31 times is not a margin of safety. It is a price built on the assumption that the next 3 to 5 years will go exactly as planned. His entire philosophy was built on the observation that plans do not always go exactly as planned. Then there is the concentration risk. One customer segment, hyperscaler AI CapEx, drives the majority of revenue. If the training cycle plateaus, if ASICs from Google and Amazon take meaningful share, if the China export ban becomes total, any one of these events changes the earnings picture dramatically. A company priced at 31 times earnings cannot absorb a large earnings miss. It has no cushion. He scores it a 1. The margin of safety is not thin. It is absent.
A 1 and 8 to a 1, the largest spread this board has ever seen, and we are not done. Next, the legend who bridged their two worlds. Peter Lynch, he ran Fidelity's Magellan Fund to returns no competitor has matched. His method was deceptively simple: find great businesses growing faster than their price implies and own them before Wall Street figures it out.
Lynch's model runs the PEG ratio first, and it runs it hard. Price to earnings of roughly 31. Earnings growth rate of more than 80%. peg below 0.4. His published rule of thumb, a peg below 1 is interesting. Below 0.5 is exceptional. Below 0.4 is the number he spent 3 decades at Magellan hunting for in a company this size and never found. He also asks the plain English test. Can I explain what this company does and why it wins in 60 seconds? Nvidia. Every AI model runs on its chips. Developers have spent 18 years learning its platform, and no one has closed the gap. That is 60 seconds with 10 seconds to spare. He trusts the business he can explain. He mistrusts the businesses that require a 3-hour presentation. The only thing that gives him pause is scale. A peg of 0.4 at a $200 company is a 10-bagger waiting to happen. At $5 trillion, the math is harder. For the stock to double from here to 10 trillion requires growth that has never been sustained by any company in history at this size. He believes in the story. He believes in the growth. He notes honestly that the law of large numbers is Nvidia's one undefeated opponent. He scores it a 7. The peg is real. The scale risk is real. Both are true.
A 7, Lynch is a buyer with a caveat. Now the investor who scored the Apple business a 7 and sold 600 million shares of it in the same breath. Warren Buffett, he has never needed to own the most exciting company in the market. His method is narrower than that. Understand the business completely, verify the moat is durable, and never pay so much that time cannot bail you out.
The Buffett model starts with the circle of competence question, and Nvidia presents a genuine problem. He has stated repeatedly and publicly that he does not invest in technology businesses he cannot evaluate a decade out with confidence. The AI infrastructure build-out is real. The CUDA moat is real. But the durability question, will GPU-based training dominate in 10 years or will it be replaced by something he cannot see yet, is a question he genuinely cannot answer. And his entire framework is built on never pretending he can. He would also note the customer concentration. 40 to 50% of Nvidia's revenue comes from 4 companies: Microsoft, Google, Amazon, Meta, all of whom are simultaneously Nvidia's best customers and its most motivated competitors. They are each building their own custom AI chips. Google's TPU, Amazon's Trainium, Meta's MTIA. They are paying Nvidia tens of billions now because they have no choice. The question is when they do. He admires the engineering. He recognizes the moat. He notes that the returns on capital are extraordinary. But he cannot value what he does not fully understand with confidence, and at 31 times earnings, there is no margin of error for the thing he cannot see. He would say, there are businesses I know I cannot properly evaluate. Nvidia is one of them. Respecting the limits of what you know is not a failure of nerve. It is how you avoid the mistakes that look obvious in hindsight. He scores it a 2.
A 2 from Buffett, an 8 and a 7 say buy, a 1 and a 2 say never, 1 vote left. And this one knows how to read what the room believes before it believes it. Stanley Druckenmiller, he returned 30% per year for 30 years at Duquesne Capital, a record unmatched by anyone who ran significant capital for that long. His method, find asymmetric positions where being right pays a multiple of what being wrong costs.
Druckenmiller's model identifies Nvidia as the most asymmetric infrastructure play in modern markets. When a genuine technology paradigm shift occurs, the internet in the 90s, smartphones in 2007, AI now, the company that owns the mandatory infrastructure compounds faster than any model predicts. He watched the internet build out from the front row. He knows what it looks like when CapEx spending is not discretionary. The hyperscalers cannot not buy GPU capacity. That is asymmetry at the infrastructure layer. He also manages risk with unusual precision. The China Senate hearing is his key tail risk. A total ban on H-20 exports does not just cut $14 billion of revenue. It tells the market that the US-China AI arms race has a new front, and that Nvidia's global addressable market is permanently smaller than the bull case assumed. He would size into this position but leave room to exit fast. He does not believe in holding through structural thesis breaks. His framework gives the highest weight to cycle positioning. Where are we in the infrastructure build-out? His honest read is that we are somewhere in the middle innings. Hyperscaler CapEx is still accelerating. Model complexity is still scaling. The upgrade cycle to the next GPU generation is already locked in by procurement contracts. The plateau is coming, every cycle ends, but it has not arrived.
and in an asymmetric position, he rides momentum until the structure changes. He scores it a 6. Strong conviction, managed size, clear exit trigger on China. A 6, the macro maestro is in with discipline. So what does the whole board say? 5 legends, 1 company, Fisher 8, Lynch 7, Druckenmiller 6, Buffett 2, Graham 1. The combined great score for Nvidia in June 2026, 4.8 out of 10. 4.8 does not mean mediocre. It means the board is split in a way this series has never seen before. The gap between the highest score and the lowest score is 7 points, 7 points on 1 company. Every legend in this room looked at the same balance sheet, the same margins, the same CUDA moat, and reached an answer between 1 and 8. Fisher gave it an 8, Graham gave it a 1 on the same business, the same $44 billion quarter, the same 75% gross margins, the same 18-year CUDA moat. This is not a disagreement about facts, it is a disagreement about which facts matter, and that disagreement is the lesson. Fisher and Lynch use growth frameworks. When earnings are growing faster than the PE multiple, their models say buy. The peg is below 0.4. That is a strong signal by their logic, regardless of absolute price. Graham and Buffett use safety frameworks. When there is no margin of safety, no floor below the price you paid, their models say no, regardless of growth. Both frameworks are internally consistent. Both are correct within their own assumptions. The question is which assumption fits this moment. The growth investors are saying yes because they believe AI infrastructure demand is structural, like the internet, which also looked speculative in 1999. The safety investors are saying no because they cannot verify that GPU-based training will still be the dominant paradigm in 2035. Both answers are honest. Neither is provably wrong today. The bull case in one sentence: 1 million developers have spent 18 years learning one platform, and every new AI breakthrough adds another layer of dependency on it. The bear case in one sentence: in technology, the things everyone is sure cannot be disrupted tend to be the things that get disrupted. This is why the spread is 7. Both sentences are true. If you are a Druckenmiller-style investor, you are watching one variable above everything else: the Senate-China export hearing. A total H-20 ban does not destroy Nvidia. The domestic and European and Japanese AI build-out continues regardless. But it caps the total addressable market, it removes the urgency from the next upgrade cycle, and it tells the market that geopolitics is now a permanent input into Nvidia's earnings model. That is a different stock than the one the bulls are pricing. 4.8. The board is split because the right answer depends on which lens you bring. Bring growth frameworks and Nvidia is the most attractive large cap in public markets. Bring safety frameworks and there is not enough floor to stand on at 31 times earnings with a $5 trillion market cap. This is not a flaw in the board's design. It is the board doing exactly what it was built to do: show you the disagreement clearly enough that you can decide which method fits your own framework. The board judged the method, but methods outlive their authors. So here is the question only the living can answer. The investors who actually move billions today, are any of them buying Nvidia at $5 trillion? We pulled the filings. We tracked 15 of the most followed living investors. Only 2 of them hold Nvidia at all, and here is the tell: both of them are cutting. David Tepper trimmed his stake, Dan Loeb cut his by 94%, and Michael Burry is not long at all. He is holding 1 million shares of put options, a bet against it. The 2 legends still in are sizing down. The smart money believes the story. At this price, it is quietly heading for the exit. Last, the noise. Right now Nvidia pulls about 5.5 times the public attention of the typical chip company, the most watched stock on earth. A spotlight that bright with the smart money sizing down beneath it tells you the same thing the board did. The crowd has fully arrived and the story is running ahead of the math. So watch 3 things from here. Does the Senate's China export decision cap the market? Do Tepper and Loeb keep trimming or step back in? And does the spread, the widest this board has ever recorded, finally start to close? Those answers decide whether the bulls or the bears were right. If you invest like Fisher or Lynch, and you believe the AI infrastructure cycle is structural and multi-year, the peg below 0.4 is a genuine signal. It is the kind of number those frameworks were built to surface. If you invest like Graham or Buffett, and your first question is always, what do I lose if I'm wrong? Then a $5 trillion stock with no asset floor is exactly the kind of position those frameworks were built to avoid. The Greats Playbook does not tell you which framework is right, it tells you where each framework lands and lets you decide. Nvidia scores 4.8, the spread is 7. Both things are real. What do you do with that? Leave your number in the comments and we will see which Legends method the market proves right.